In our strategy, we use a five-phase cycle framework. We are not predicting headlines. We are tracking signals and sequencing pressure as the cycle evolves. This episode is about a violent silver move that looked chaotic on the surface. But underneath, the mechanics were very structured. The key question is what actually changed and what did not. We are reviewing a recent video by John A.G. on the silver sell-off and rebound. He focuses on futures market mechanics and physical market stress. You should watch the original video for the full technical detail. The claim is that silver did not collapse because demand failed. It collapsed because leverage was forced out of the system. That distinction matters late cycle. Margin requirements were raised rapidly. That increases the cash needed to hold leveraged positions. When leverage is high, forced selling becomes mechanical. Once margin calls hit, positions are closed automatically. Stops trigger more selling. Price speed accelerates even without new information. At the same time, paper prices fell. Physical premiums rose. That divergence is not unusual in late cycle stress. Liquidity clears first. Inventory adjusts later. Some mints paused sales or repriced rapidly. That signals operational strain during volatility. It does not by itself confirm a new regime. The video highlights vault withdrawals in Asia. Physical metal moved out during the price drop. That is a signal worth monitoring, not a conclusion. Rising lease rates suggest scarcity of lendable metal. When borrowing costs spike, holders demand compensation. This often appears when stress is rising. In our strategy, this aligns with Phase 2 pressure. Volatility increases. Liquidity mechanics dominate fundamentals. It does not confirm the end of downside volatility. It does not guarantee trend continuation. Forced selling can repeat before stabilization. Short-term consolidation carries higher probability than clarity. Sharp rebounds can happen without resolution. Confirmation requires persistence across signals. If you follow these episodes regularly, you know this pattern. Late cycle markets often break in plumbing first. Price moves are symptoms, not the diagnosis. If this way of thinking is useful to you, consider subscribing. The goal is not speed or hype. It is having a consistent framework when volatility rises. Quick disclaimer, this is educational commentary only. It is not financial advice. We pay closer attention to physical paper spreads. We respect liquidity stress more than narratives. We stay patient for confirmation. We do not chase price. We do not abandon phase discipline. We do not need to be early. We just cannot afford to be late.